Well, good morning, everyone. Appreciate everyone being here on time for our 10 o'clock start. Uh, it's interesting. We've got great participation. Our usual diverse international group here for the economic update. So glad you're here. I wanted to make it clear on the front end that neither Taylor Swift nor Travis Kelsey registered for the webinar. So those are you who are here to see them pop up on the screen. I apologize. They will not be here today. We hope to give you a general overview of the key issues impacting the U.S. and the global economies. We're focusing on those areas that will impact most of our attendees, and we hope you have questions. We've had some submitted, but please feel free to drop your questions in the chat box. There's going to be ample opportunity later in the presentation to answer them. For those of you who have submitted them, thank you. We'll make sure that either Patrick or I get those and make sure we cover those during the presentation. So let's review a quarter of continued growth, change, and of course, uncertainty. When we had our Q2 economic update just 3 months ago, the US economy was beginning to slow slightly. Inflation was slowing. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed rate adjustments will result in a, quote, soft landing. We'll talk more about that later. And we're kind of adjusting to the new norm. We're still in a post-COVID balancing world, and things are shaking out, getting there, getting back to some sense of norm, and we hope that that can continue. Americans continue to spend money with family and friends, travel and entertainment. We're going to talk about that with GDP numbers that just came out. And as a result, even if they're having to spend a lot more than they did pre-pandemic, they're still spending. The pandemic period savings have dwindled. Student loan payments are resuming. Rises in wages are cooled, but still happening. Social Security recipients got a 3.2% increase. So what does all this mean? Well, joining us today is Patrick Gauthier from the CPS Investment Advisors. Pat is the Chief Investment Officer with CPS. And at this point, Pat, I'm going to make you the presenter.
Excellent. Thank you, Marshall, and good morning, everyone. I appreciate the invite to come back and speak with everyone on the economy and the market and what we see out there today. So we are going to take a look at some of the things that we talked about throughout the year. You know, if we circle back to the beginning of the year, we see recession predictions. You know, raise your hand if you saw a headline in January that said we would already be in a recession. Fed rate hikes would cause the economy to stumble, and we would be on the path to lower interest rates by this point in the year. That was pretty much a consensus if we rewind to the beginning of the year. Well, it's October, and we're rounding into the fourth quarter, and we're wondering, okay, what's going to happen moving forward? The main question is, how high can rates go? Which is a much different story than we started the year with. So certainly an interesting year so far in the markets, and there's a little room to go to keep it interesting for the rest of the year. So let's dive right into rates. How high can rates go? I find this chart very interesting. We're looking at the target federal funds rate. Shows us the upper limit of 5.5. So what this means is that the Fed funds rate is 5.25 to 5.5. And there's two very interesting points about this chart. The first is looking back. We went back into the 90s to show you that, you know, 5 or 5.5 on the Fed funds rate is really not unprecedented. This is not uncharted territory. We've been through this before, and I know you've even heard me talk about this. You know, back in the 80s, folks were happy with those double-digit mortgages. They were happy to get 10, 12%. If you throw a 10 or 12% 30-year mortgage out there now, folks aren't going to be too happy. We just topped 8% recently on the 30-year, and we've got some numbers that show that home purchases are down dramatically from where they typically are. So this is the rate path that we've followed here so far, and that's the second takeaway for the federal funds rate chart is the speed at which we've raised rates from the Fed side of things. So it's not unnatural to be at this level of rates. What really is significant here is the speed at which we've raised those rates. You know, equate this to driving a golf cart. If you hit that brake really hard, that thing is going to stop, and that's what the Fed has been trying to do with rates. And you can see it here. That's a pretty steep hill to climb. If you're on your Peloton at home and you see that one coming, you better gear up because that's going to be a tough one to get through. So what did that do to the economy? The goal here was to bring inflation down. So we look at the peaks in inflation. Your headline numbers got up to around 9%. Your core and PCE, which we've discussed in the past, down a little bit lower there. But it's important to highlight the average inflation numbers. And this is where the Fed gets its long-term target of 2% or so for inflation. So on average, looking back over the last 10 years, we're 2.25 on, 2.5 on these measures of inflation, depending on which version you prefer. So again, two important trends here with inflation. The Fed hikes and subsequent moves have started to bring inflation down. So you can see at the tail end of the graph, there's a move in the right direction. We have some work to do still till we get back towards that long-term 2%, but at least we can say, there's light at the end of the tunnel and we're heading in the right direction. And the reason we brought it back 10 years was to illustrate that for a very long time leading into COVID, we were below 2% inflation by just about every metric. So if you're looking at, reversion to the mean, that statistical concept that most of us are familiar with, getting back to 2% isn't necessarily a hard and fast goal. If you approach 2 and you're at 2.25, 2.5% inflation, you can sit at that point for a long period of time and still have an average long-term inflation at 2%. So I say that to really imply that, there's some ground to make up in terms of long-term average inflation. We can run at 2 to 3% inflation for a number of years, and we'd still have a pretty good looking average over the long term if you extrapolate that back a decade or so. So if I have any predictions here, which I'll try to stay away from, it's that 2% exactly for the inflation metric, whichever way you look at it, isn't necessarily the hard and fast goal. You really want to look at those long-term numbers and say, are we at a healthy place where the economy is growing and we have a little bit of inflation? Well, it's important to remember inflation has made the boogeyman in the media and the headlines, but a little bit of inflation is healthy for the economy and is necessary for employment and to keep things growing over the long term. So you would think that with credit tightening and interest rates rising and what we feared was a recession coming here this year, that we'd have some turmoil in the job market. And we're happy to report that that has simply not been the case. We have initial claims for unemployment on the top here, still below historical averages. The good news is that they're creeping back towards average. That means the labor market, which was very loose for a while. You could go get a job, you could switch jobs and get a significant pay raise. I know on the accounting side of things, it's been very difficult to find accountants. There are a lot of open jobs out there on the market, which we see on the bottom chart that show us there's somewhere under 10 million open jobs in America at the moment. The good news is that's trending in the right direction. We had a brief spike in September, and we're going to get some October numbers soon. But we're looking at that trending in the right direction. It's counterintuitive to say that we want fewer jobs available out there in the market. You tend to think that the more opportunity consumers have for jobs, the better off the economy will be. But part of that equation is that job openings and the demand for labor raises wages. And we know the good old American consumer, when we have higher wages and money to spend in our pocket, we're going to go do that. And 90% of us are going to go spend more than we have. So the more money and opportunity we have, the more we're going to spend and create demand for goods in the economy. And that's going to keep prices high, which in turn keeps the Fed on track to keep rates a little bit higher for longer. And bear with me if I say higher for longer. If I had a nickel for every time I heard that so far this year, we'd be in a much different position. But this is the job market that we're looking at and trending in the right direction. We do need to see unemployment claims come up a little bit, at least back to historical average, to get in a place where demand slows a little bit. There are some headwinds for the consumer. In terms of jobs, you might see a little bit of a a decrease in that claims for unemployment as student loans kick back in here in this past month and moving forward. Folks have that extra payment they have to make. Maybe they're going back to work where they were able to hold out for a while, or maybe they're getting that second job and getting back into the workforce to make that extra payment. So we definitely want to see job openings get back to normal, come down a little bit, and we want to see the claims for unemployment insurance rise a little bit, and that'll give the Fed what it needs to continue pausing their rate hike scheme. So I wanted to leave you with Ben here, Ben Bernanke, Fed chairman for quite a while here, one of the most informed and educated people as far as monetary policy. But again, another nickel if you've heard this one so far this year. A monetary policy works with long and variable lags. And the time between a central bank's decision to change interest rates and the full effect on the economy can be uncertain and extended. So it's a very articulate way of saying, we really aren't sure how long and how fast it'll take to feel the effects of these monetary policy changes. With all the information we have in the world and all the education behind the people in the open market committee, you still are never really certain as to what these changes, interest rate policy and monetary policy, are going to do for us. And that's important when we move forward, because we're looking at a situation where we've done some things in the last decade or so that really haven't been done in the past. And so there isn't a lot of historical precedent to really predict what will happen. There's a lot of economic theory behind it, but we'll look at some numbers here to show you that there's a lot of uncharted territory moving forward. The first is the money supply. So we took this all the way back to the 60s to give you a really good illustration of how money has changed over time. We've got a little bit of gold standard in there back in the 60s, and then we're moving forward into more modern monetary policies. But you can see it had a steady rise since the 70s, when the Fed was able to start printing dollars not being backed by gold. And then we look into the 2000s and 2010 and beyond. That's when you started the quantitative easing cycle. So the Fed was able to print money, inject that money into the economy, and grow the supply of money, which is meant to keep costs low and make money flow through the system to help alleviate credit concerns and keep funding moving for governments and businesses. Then on the right side here, 2020 and beyond, you see a logarithmic increase, or an exponential increase, if you will, of the money supply. And that's your COVID stimulus. That's your fiscal policy of spending that wasn't paid for. The economist in me wants to stay out of the politics side, but we all know that the federal government runs a pretty significant deficit and has for a very long time, and it doesn't look like that's going to change. But we're increasing the money supply dramatically. And what you see at the very end is there's a brief downturn. So we've turned a corner from a monetary policy of pumping money into the system, and now we're at a point where we're starting to see the supply of money decrease. And why is that important? Is because if there's less money moving around in the system, credit will be a little bit tighter. You'll start to see lending slow a bit. It'll cost you more to borrow money. It'll cost businesses more to refinance their debt. And what happened with a lot of balance sheets from 2000 up until now is companies went and they borrowed, and if they didn't have a good project or R&D to invest in, they bought back their own shares. They bought their competitors, they bought back their own shares, paid out increasing dividends, which we're a huge fan of dividends. But as you've seen money flow into the system over this time frame, you've seen companies consolidate. There are fewer publicly traded companies this year than there were in years past. That's a continuing trend. There are fewer shares outstanding for your large companies. They're buying back shares to reduce their obligations out there in the market. So as that flow of money slows, it'll be interesting to see how balance sheets are affected, how earnings per share numbers are affected. Those are some of the financial statement mechanics that can be done out there to make your company look good, when in reality you still have to drive revenue if you want to continue to be a high quality business. But let's take one more look at the money supply. This is a look of the year over year change in the money supply. And it illustrates, again, a couple of points. One being that the money supply does change every year, so it's a fluctuating number. It's certainly not constant. You have seen some fairly large spikes, 10% or more in the money supply, typically followed by a smaller increase in the following years. And we have had years where, the money supply barely grew, and that's fine as well. But really on the right side, we're looking at a significant increase in the money supply. And now we have a significant decrease in the money supply. And again, we took you back into the 60s here to illustrate that there really hasn't been a time in history where we've seen the money supply decrease to this magnitude. All of these numbers in orange are positive numbers. So the money supply has grown year over year from the 70s until last year, basically. So uncharted territory, not only for the Fed, but for the economy. You have all these businesses that had easy funding. If you had an idea, maybe a little bit of tech or this summer AI behind it, you would probably going to get funded and not have to borrow a significant amount of money to run or start your business. And now that's changing. There's less money floating around. It demands a adequate rate of return. And we're seeing that take place in not only the debt markets, but mortgages and things of that nature. So snapshot of the year here for us. We're into October. We started the year pretty strong. We had a pretty solid first quarter where we looked at, okay, maybe we're going to get one or two more rate hikes and maybe some cuts at the end of the year. Inflation had some other ideas there in the second quarter, and we saw the markets temper a bit. And then you can call this summer, the summer of AI, if you will, and we had some hype behind technology, and we saw the NASDAQ spike quite a bit over the summer. Then to be outdone by the reality in the markets starting to digest the idea that rates may stay higher for longer, and there's another nickel I have to give back. But we are starting to see markets contemplate, okay, businesses still need funding. The consumer is running out of credit and running out of COVID stimulus savings. Who's going to be spending the money? What are they going to be spending it on? And are all the excess businesses out there that were funded with cheap debt and running on no revenues and dreams, if you will, how long are they going to last, and how long can they last in a higher rate environment? I want to jump back for a moment and cover something because it's interesting, this chart on the money supply. A lot of folks want to place the blame for the slowdown in the housing market on the Fed funds rate being at 5%, which a lot of folks will say in turn takes the 30-year mortgage rate to what we've seen about 8% here recently. One of the real culprits that has an effect on it, the Fed funds rate can dictate the short end of the curve. The 10-year Treasury is often touted as what 30-year mortgage rates are based on. But when you look at the money supply, how is the Fed reducing the money supply? They are no longer purchasing mortgage-backed securities. So I don't want to dive into the whole, MBS market. It's pretty convoluted, but basically for the last 12 to 14 years, the Federal Reserve has been the single biggest buyer of mortgage-backed securities in the market, period. So if you're a mortgage originator in 2010 or beyond, you were happy. You knew that if you wrote a loan at 3%, the Federal Reserve was going to allow you to package it up and sell it to them, and they were going to buy it, whether they were going to make money on it or not. And that's the difference about the Fed, is they're not concerned with return on investment. They were simply buying those mortgage-backed securities, those big pools of mortgages and other loans, to stimulate the economy, which they did to great effect. Now the opposite has happened. They're no longer buying those securities. So the biggest buyer left the market. They're letting those securities mature, and they're keeping that cash on their balance sheet. So that's called quantitative tightening. I know we've talked about it in the past, but basically it's effectively taking money out of the system, and that gives you that reduction in money supply that we see here. So back to the economist in me, supply and demand. If your number one purchaser of a product is no longer in the market, that leaves you with your second, third, and fourth tier purchasers. And who are they in the mortgage-backed security market? They're your large institutions, they're your pension funds, they're your mutual funds, insurance companies. And the big difference between them and the Federal Reserve over the last decade is they care about their return on investment. They're buying those securities to achieve long-term income and return above and beyond inflation. So as we see rates moderate a bit, you don't necessarily have to see mortgage rates follow in lockstep. That market is much more derived on supply and demand and who's going to be the ultimate holders of that mortgage debt versus what the prevailing interest rate is on the short end of the curve. So I appreciate you sticking with me for that short detour there, but that's important because housing drives so much of the economy. We are seeing, a lot of folks stay put with their mortgages locked in the 3 to 4% range. Marshall may have this number and we can reference it, but it's somewhere in the 80% range of all existing mortgages are under 4% at the moment. So your typical consumer is not going to trade that for an 8% mortgage willingly, unless they're in a much better financial position than they were before. So interesting note on the mortgages and the housing side of things, and we'll get you back on track here. So still a strong year in the market. If you fast forward this to the end of December, I would expect to see just a little bit more volatility moving forward. We have all the hallmark things that we'll touch on in a bit that will cause volatility. We still have Russia, Ukraine. We now have situation in Israel. We have politics and budget deficits and spending bills. And then we're moving into an election year, and who knows what other headline might rear its head over the next couple of months. But we'll see if the consumer stays strong and wants to keep the American economy afloat through the holiday season. But I do challenge you as long-term investors in high-quality companies to zoom out, go to that 30,000-foot view and say, hey, over the last decade, at which point was a bad time to invest? Now, certainly there are points where you would have invested at a peak. So, you want to have that long-term mentality of over time, I'm going to watch high quality companies compound, grow in value, and continue to return value to shareholders in the form of dividends. But, we could put a timeline up here of all the major events that happened in the last decade, and some of them are very scary. They create very scary headlines, and the newsmakers are very good at pushing that for us. But keep that long-term perspective in place. You have significant growth opportunities in the market. There's no better place to invest in the United States. If you look at all the innovation in the world, it happens here in the U.S. It's the best place to start a business, the best place to get funding for a business, and we have the best workforce in the business as well. So again, I appreciate your time this morning. Always a pleasure to be back. I'll turn it back over to Marshall and stick around for any questions.
Pat, as always, just a great presentation to bring us up to speed. We've got some good news to share, some questions to answer, and so we'll move forward with the economic update. The real key that we see headed in at this point is looking back at a variety of things. And before I get into this particular slide, what I wanted to cover was what didn't happen last quarter. To me, that's very important. When we left off at the end of the second quarter update, we were hearing that the U.S. was going to default on its debt. Well, it didn't. We heard that the U.S. dollar was going to cease to be the world's currency. Well, it hasn't. We heard that corporate earnings were going to collapse, and they didn't. And we, of course, knew, as Pat alluded to, that the U.S. economy was going to fall into a recession. And when I get to GDP, you can just shake your head on that one on your own accord. So what did happen? Well, inflation moderated a little bit, but it's at least trending downward. The result of the rising interest rates and other factors have got inflation headed at least in the direction that the Feds want it to, and of course, as we all want to. Political tensions still volatile. We didn't have the strikes last quarter. We do have the strikes now. I understand that as of late last night, Ford and the UAW have reached a temporary accord. So that's good. Strikes aren't good for the economy and are really, they're a challenge. The geopolitical tensions have gotten more volatile. Talk about that in a minute. Interest rates are relatively low, but they're still higher than we're accustomed to. We got spoiled there for a number of years. Unemployment still historically low, but we've seen a little increase in first-time unemployment applications. Demand is still high, but it's waning a little bit and supply chains seem to have returned to their pre-pandemic timeframes, which is good. We were seeing container costs shipping from the Asia area in the $30,000 to $40,000 per container. Now they've dropped to zero on that. You're getting them for $3,000 to $4,000. So this is good as replenishing the supply chains and getting the goods and services back to the U.S. Surprisingly enough, I love this little chart. Most economists now think that the Feds are going to pull it off. We're down to 48% who don't think we'll have a soft landing. So 52% are actually believing that the Feds are going to end up with a soft landing. And with what we saw today and on GDP in a couple of minutes, we'll see that it's going to be there. So what is a soft landing? Well, whatever you call it, GDP is slowed, which is generally a bad thing. But in this case, it's the goal of the Fed. The question is, what will growth or lack thereof be for the remainder of 2023 and beyond? Earlier this year, economists and the Federal Reserve predicted that the U.S. economy would be sputtering by now as higher interest rates cut into spending and investments. The opposite is happening. Recent economic data suggests the economy is accelerating despite higher borrowing costs, the resumption of student loan payments, and wars in the Ukraine and the Middle East. Chairman Powell says there will be growth for the full year. I think he's probably right. There's increased forecasting for a slight recession, but that's moved now to Q3 or Q4 in 2024. As I like to say, that'll be right in the heat of the election, so that could be really interesting. But the one thing that you always understand that predicting a recession is a little like predicting rain. If you keep making the prediction long enough, it actually occurs. In multiple statements, though, Chairman Powell has left the door open for future hikes in the near term based on evolving data in the coming weeks. Kind of what I'll call a watchful eye approach. The Fed meets next Wednesday and then again on December the 13th. With some of the question marks that the November 17th government shutdown question mark, a couple of other things. General consensus right now, they'll continue to monitor in November, but would almost definitely have at least a quarter of a point before the end of the year, which would be the December 13th meeting. So, what's happened to GDP? Well, this morning's announcement was up 4.9%. I'm not sure anyone anticipated that dramatic a level of growth. The economic consensus was 4.2. The economy is still warm, but wow, that's getting back to closer to the 2021 numbers, right between 2021 and 2022. Consumers spent on the refilled supply chain, on vehicles, online purchases, and of course, dining and entertainment. The concert circuit for this year was a major boost to the economy. The question still remains, what's going to happen this winter when the savings are now exhausted, student loan payments have resumed, credit cards are maxed, and higher interest rates are making financing cars, appliances, and other things less affordable. Gonna be interesting, but wow, what an unbelievable quarter. Inflation. It's continued to subside, but it sure doesn't seem like it at the grocery store or gas station. And 3.7 versus 3.0 shows us that, yet the economy is still warm. The interest rates have had impact, but nowhere near the level that I think the Feds had anticipated. Geopolitical political tensions. Remember the debt ceiling crisis that we had? Well, both sides claimed victory. The real winners were the pork recipients whose votes were purchased, and the losers were the American taxpayers. Congress managed to kick the can down the road until November 17th, so we'll see what happens when we get there. We heard for months that the resumption of federal student loan payments would be a big deal for the U.S. economy. Well, according to research from the Federal Reserve Bank of New York, millions of student borrowers are likely to curtail their consumer spending by about $56 a month on the average as they restart student loan payments. Well, across 28 million student loan borrowers, that amounts to 1.6 billion less in consumer expenditures. The findings suggest that the payment resumption will have a relatively small overall effect on consumption, to the magnitude of a 0.1% reduction in aggregate spending. So based on what we've seen from the GDP, with a 0.1% reduction, it's a blip on the screen. In the meanwhile, US debt continues to run rampant and unchecked. And of course, with higher interest rates means higher expenses for the US government on their treasury debt, which of course is going to increase the spending and increase the debt. It's a spiral effect. We've got Donald Trump and 12 other declared Republicans. We have Joe Biden and 2 other declared Democrats. We have Robert Kennedy Jr. and 1 other third party candidate. Who knows what that's going to all look like? But I do have some good news. There's only 376 days left of campaign ads before Election Day. So all we got to do is get through 376 days and we'll know what's happening. The biggest question I have as of today is, well, who is Mike Johnson? As you've probably read today, Mike Johnson is the new Speaker of the House. What we know is he's a conservative Republican from Louisiana. I'm sure in the next couple of weeks we're going to get to know a lot more about Mike Johnson, but at least we do have a Speaker of the House as of today. Who knows what tomorrow brings? On the geopolitical side, other than Israel, things haven't really changed very much last quarter. The concept of a global economy continues to become more evident. The European dependency on Russian energy, Ukrainian wheat, and other products, coupled with the disruption of the Ukrainian production, is choking an already shaky Eurozone economy. The war in Ukraine continues to escalate into a proxy war between Russia and the West. China continues to support their neighbor Russia and threaten hostilities against Taiwan. North Korea is a perpetual question mark as to what they're doing. That's a whole nother story. And of course, OPEC continues to impact oil prices based on their production quota modifications. Good old free enterprise. Remember when the U.S. was being independent on oil? Well, we'll see how that comes in the coming months. Interest rates. The near record high prices around the U.S. have made it difficult for first-time buyers to compete. Interest rates have more than tripled since 2021, and according to my realtor clients, the biggest hurdle is still supply. Existing homeowners aren't willing to give up that 2.5% mortgage rate in exchange for 8 5/8. But the overbidding war has ended and the new home inventory is increasing. I'm going to show you some more on that in just a minute. Demand for mortgages has fallen dramatically. The pace of increases has cooled off dramatically as rates scare off sellers, buyers, and builders alike. Mortgage refinancing is basically non-existent, and rental demand is beginning to wane slightly as higher prices are pushing more people to considering doubling up or moving back in with relatives. The 10-year Treasury, of course, is the driving force between the 30-year mortgage rates. And so we look at the 10-year Treasury chart and we see that there is still a strong upward trend. It's up and has risen as high as over 5%, 5.021 on Monday of this week, up from roughly 3.8% at the start of the year. Yields, which rise when bond prices fall, have climbed since the start of 2022, when investors began worrying in earnest that the Federal Reserve might start raising interest rates. And of course they did. In recent weeks, that sell-off has become more intense. This is a chart on 30-year mortgages. Check this out. The monthly payment on the average price home was about $1,000 before the Fed started raising rates. That same home today would have a low monthly of over $2,350. So we're looking at almost 2.5 times for the same house. And we haven't even broached rising taxes and rising insurance yet. So this is a real challenge for the housing market that is, of course, a huge driver of the U.S. economy. We've also got another interesting slide, and that's this one. This is one Pat alluded to in his presentation. I'm going to leave this up here and go through it a little bit slowly, but basically it's active interest rates by uh, when their vintage. How long have they been out there? And what obviously immediately catches your eye are the green lines, which were the loans that were introduced back in 2020 to 2021. So just a really key to observe what's happening with those various loans, and the fact that people won't change, um, or don't want to change their loan. They don't want to give up those nice green loans down there in exchange for some of the golden stuff up at the top. So it really gets intriguing, to say the least. It's hard to believe some of those older vintage loans are out there in those 6.25%, 7% range, but I guess it's people who missed the opportunity to refi and haven't jumped on it. Now, one thing that's really interesting happening is that the high mortgage rates are also limiting the inventory of homes on the market because they're locked, and that's pushing the demand to new construction. The number of housing permits issued to single family homes rose for the eighth straight month in September, and that's the highest level since 2022. So we're seeing about a year and a half after the 2022 high, we're coming back again on the new home starts. However, home sales fell in September to the lowest rate in 13 years, showing the corner of the economy has most weakened by the high interest rates remains in decline. Existing home sales, which generally make up most of the housing market, decreased 2% in September, the lowest since October of 2010. Long, long time ago. September sales 15.4% from a year earlier. Again, this is existing homes, not new construction. Demand for mortgages continues to fall, and rental demand, of course, I mentioned a moment ago. So what's happening in the unemployment world? Well, we're still hovering in that upper three range. Strong hiring is fueling new spending. By some measures, the labor market got stronger over the course of the third quarter. Employers added 336,000 jobs in September, and that's up from 227 in August and 236 in July. So some quick math tells me that's almost 750,000 new jobs in just the third quarter. That's phenomenal. But yet, consumer confidence is down. U.S. consumers say they aren't feeling great about the economy, but they sure have a curious way of showing it, as we noted in the GDP numbers. Pessimism about the economy continues, but despite inflation's negative impact on purchasing power and sentiment, consumers keep spending, and that has been just remarkably resilient. Why is this happening? Simply, consumers had money. However, these savings are becoming depleted amid the high inflation. The latest round of bank earnings show that apprehension still hasn't kept Americans from reaching for their credit cards. One of the people I follow is Wharton professor Jeremy Siegel, and he noted that many of these spenders are what we refer to as YOLO spenders, as in you only live once consumers. They're spending their last cash reserves on traveling, enjoying the summer, the early fall, and now that we're headed into winter, we'll see what happens. But that's been the driver. Where was the money coming from? I mentioned the credit cards. Look at the change in credit card balances. And again, this is from the Fed Reserve in New York. And you can see just the dramatic increase has occurred. That downturn in 2021, remember, people were getting stimulus checks and they couldn't go anywhere. So credit card balances declined. And let's see where it's going. Well, the restaurants and bars are doing great. Drugstores, auto dealers, and are all doing great. And of course, we don't really get an option on the grocery store. We're going to spend there. But the clothing, there's a little blip from the WFH people, the work from home workforce headed back to work. I think there was a little clothes buying. But all that money that was being spent on sports and hobbies and things like that a couple of quarters ago isn't there. and gas declined a little bit. And of course, people are no longer doing the home improvements and buying the furniture for the house. So, very interesting shift in the consumer dynamic as a portion of GDP. But what's happening with leading economic indicators? Well, those too are down. Now, ordinarily, if I saw that over the last year we've dropped about 6 points in leading economic indicators, I would be concerned. But with the Fed goal of slowing the economy, a slighter LEI is a good thing. So we'll look at it in the positive light because we like to be positive. We'll put it that way. So investing in certain times, of course, the following are not recommendations to buy or sell. This is for informational purposes only. And I have to allow your permission for just a minute. A couple of really cool things. On next Wednesday, November the 1st, our firm will be 45 years old. To me, that's just an awesome milestone for us. It's something I'm extremely proud of. And the second thing that I have is I'm celebrating somewhat of an anniversary this month that 50 years ago, October 1973, I was in my senior year at Jacksonville University. My finance and investing professor had awakened an interest in me that burns intensely even this day. It was the fall of 73 when I made my second stock purchase. There's a long story about my first. Ask me privately for that sometime. My source of information was my student subscription to the Wall Street Journal, and that's the way it is, each evening at 6:30 from Walter Cronkite. A side note, I'd later have the honor to meet and serve on a charitable board with Walter before he passed about 15 years ago. So please indulge me as we take a little trip down memory lane. I know most of the people on this presentation today, and most of them were born before January 1, 1973. So it's a lot of we in here as we go through that. You've already lived through 3 episodes in which the U.S. stock market went down by roughly a half. Let's reflect back on those. January of 1973 to October 74, the market lost 48% of its value. Recovered. March of 2000 to October of 2002, we lost 49%. And then again, in October 2007 to March of 2009, we lost 57%. The critical point of these crises was very real. These weren't thunderstorms. These were hurricanes. As we look back at 1973-74, this was the largest decline since the Depression to that date. It was marked by a crescendo of crises. They were economic, financial, political, and even geopolitical. Many historians judge October 1973 as the onset of the very worst confluence of constitutional, geopolitical, and economic crises our nation had ever seen. Gas prices quadrupled. The president resigned. Americans slept under the very real threat of a Cold War morphing into a nuclear war by morning, and the stock market dropped 48%. Topics Walter was covering every evening were Nixon, Watergate, Israel, the Soviet Union, oil embargo, nuclear war, gas prices, inflation, recession, and unemployment at 9%. Wow, many of these sound like the 24-hour news we're receiving today. I was watching intently, but there wasn't anything good. Remember, I was about to graduate and enter the real world. In November 1973, I made the second stock purchase based on a daily barrage of reasons not to invest. My second stock purchase was Winnebago. Why Winnebago? Nobody wanted it. Gas was expensive, and I would turn around and sell it less than a year later for a 50% return. That was a lesson that has lasted me my entire career. Fast forward to March of 2000. The dot-com was probably the greatest stock market bubble of all time, and after Enron, no one could believe any accounting numbers. Then came the terrors of 9/11, a tough time that we all remember. And last but not least, 2007 to 2009. This was the big one. In a real way, this was the generation's 1929 to 1932 experience. Again, the cry was, this time it's different. But was it? We had the subprime mortgages. We had the global financial issues, the longest recession since the 30s, and unemployment again at 10%. So what's happened since then? When I reflect on the last 50 years, I, like so many of you with us today, experienced the Nixon resignation, the 1980 20.5% prime interest rate, our day crash in 1987 when the S&P fell 22.6%, the first Gulf War in 1990, market down 20%, the bursting of the dot-com bubble in 2000, down 49%, the global financial crisis in 2008-2009, down 57%, the Greece-Europe debt crisis in 2011, down 20%, the COVID collapse in 2020, down 34%, and most recently, the runaway inflation Fed tightening debacle of 2022, down 26%. By my count, just during our lifetimes, we've experienced no fewer than a dozen separate crises that triggered stock market declines of 20% or more, 3 of which were 50%. Yet from the time I was a college senior to today, the price of the S&P is up about 32 times. Earnings are up 35 times. This is the ultimate answer to the question, why have stock prices risen over time? Very simple, because superior companies like those in the S&P 500 have increased their earnings. A look at the chart. The index is up 32%, but earnings are up 35%. Well, why have earnings gone up so much? Pretty simple. You first think, well, it doesn't hurt that the US population rose by 50%. But look at the productivity change from 72 to 92. It's productivity and innovation. Americans increased their productivity about 2.5 times in real inflation-adjusted terms. But the largest factor was in innovation. And keep in mind that 9 of the 10 most valuable companies in the S&P 500 today simply didn't even exist in 1972. Necessity is the mother of invention, and the mother invention is the driver of wealth. Dividends have grown far ahead. As concerned as everyone is about stock prices, in retirement, people strive to live on their dividends. And here the big story is the rate of which dividend growth has outstripped inflation. The cash dividend has compounded to about 12%, but the dividend has gone up 21%, and the CPI is up 7%. That's 3 to 1. Those are good solid numbers. But interestingly enough, as stock prices decline, it's important to remember, price and value move in opposite directions. If there's one key idea that's most valuable to hold on to in declining markets, it's this. As prices fall, things seem to be getting worse. But historically, declining prices have signaled better value in every aspect of our economic lives except one. The stock market, the stock exchange is the only place where when they have a big sale, everyone runs out of the store. That's an old Wall Street saying that I've heard for years. So where does this leave us? Well, if we look at Charles Munger, who of course is Warren Buffett's partner, if you're going to be in this game for the long pull, which is the only way to do it, you better be able to handle a 50% decline without fussing too much about it. Good advice. So what are our key takeaways? Very simple. The shares of even America's finest companies have frequently experienced declines in price. Some of these declines, driven by very real crises, have been quite significant. Despite these setbacks, leading U.S. companies have continued to grow their earnings and dividends strongly over time. Their shares have overcome even the deepest declines more rapidly than one might expect and have gone on to new types. Always remember, past performance is no guarantee of future results, but the key is we have a choice. The choice is very simple. We can go to this time it is different, which is certainly in these three crises, and liquidate our long-term equity holdings, or we can say this too shall pass, which in 4 words has been the whole message of history and really of my purpose of this presentation. As with yesterday's crisis, none of these crises du jour, the war in Ukraine, stubbornly high inflation, another surely divisive election cycle, has an obvious solution. So even as history indicates that great companies will find a way to adapt, innovate, and evolve to grow earnings, dividends, and shareholder value for patient, diversified long-term investors. So rather succumb to the media fearful headline, this time is different. Remember, this too shall pass. Turn off the noise and stay tuned. Do the things you can do. Not long ago, I came across some notes from my first financial plan I prepared for a client. The year was 1976. We had just come out of that phenomenal recession. The topics, though, were the same they are today. Financial independence and security for our families when we are living and when we are not. So sound economics and financial planning never go out of style. So bottom line, stick to the basics. At this point, I'd like to answer some questions. Let me get Pat unmuted here. Pat, hey, I got one to send you. So let me unmute you. Ah, you unmuted, Pat? I think you are.
Yes, sir. Absolutely.
Awesome. Here's our first question, and this is in bond prices, so this is your world. As bond prices fall and bond yields increase, at what yield for the 10-year Treasury would our country decline into a recession, and how long would it remain so?
That is an excellent question. I'll have to dust off the old crystal ball here.
I didn't say it would be easy. I just said we got it.
Well, as you alluded to, Marshall, we've hit north of 5% recently here on the 10-year. And if I have a moment or two, I'll share with you a recent experience. But it's going to point to what we call recency bias in economics and behavioral finance, if you will. And that's that we feel that because something has been a certain way for recent history, it has to go back to that way. And what I mean by that is lower interest rates. So I've been shopping for a mortgage. I'm one of those few unlucky people who is going to be trading a low rate for a high rate. But every mortgage originator I've talked to is dead set that mortgage rates will be dramatically lower within 3 years than they are today. The one thing they all have in common is that they've all been in the mortgage business less than 15 years. So the only thing that they know is extremely low interest rates, historically low interest rates in that field. So I briefly pulled up a chart on my end here of the 10-year Treasury rate to answer the question. And you have to go back to 2007 to get to where rates are today. And to get north of that, you have to go back to 2002 or 2001. But if you keep going back a little bit further, you hit 7.5% in the mid 90s. Late 80s, you're approaching double digits, and then early 80s, you're approaching double digits as well. You can even go back early 80s and hit 12 or 15. So I say that to illustrate that depending on your 10-year in terms of economic standpoint, you may remember those rates very well, but the economy can function at a much higher level of interest rates. It's proven that it can do that. The growth that we've seen over the last 20 years may not occur to the same extent if we have higher interest rates, but in my personal opinion, you'd have to get to double-digit interest rates on the 10-year to dramatically affect the functioning of the economy. The biggest difference between now and that period in the 80s when we were at that double-digit rate is the federal debt, the percentage of GDP that will drag the economy if we have to manipulate that somehow. But so I don't have a strict number in mind. I'm not in the camp that the 10-year has to drop dramatically for the economy to stay on strong footing. I'm probably in the minority when I say that. If we keep going higher, yes, that will eventually tip us into recession. Like Marshall said, it's like the weather. If we keep calling for recession, we'll get it right at some point. How fast that happens and how long that recession lasts is harder to say. But I do think the Fed is more prepared at the moment to fight a recession than it was, 12 months ago. That's part of the raising rate structure that we've been in, is we now have a lot more ammunition to lower rates and stimulate the economy. So I hope that answers the question, but I don't see the 10-year dropping dramatically in the near future. But I do think if we keep going too high, you'll start to see the economy slow a little faster.
Great. Thank you, Pat. Hang with us. I got another one coming up for you in a minute. But in the meantime, someone sent us, I have a mortgage on a farm that has an interest rate of 3.7. With the current poor market conditions, should I keep this loan or would it be better to pay it off? Well, we've got a short-term investment decline and a long-term mortgage. So you probably wouldn't match the two as your option. If you wanted to buy a bond, if you would, for the next, let's assume that mortgage has got another 20-year life on it, you'd be buying a 20-year bond at 3.7% if you took your capital and paid it off. With a market history of around 10%, which is about a little better than 2.5 times, 3.7% is the interest rate on the mortgage. If you look at that mortgage as a long-term investment or long-term obligation, you would definitely want to stay in the market because, hey, this too shall pass. As we have learned, looking back reflectively today. Pat, here's another one for you. I love these political ones. Will the inability of Congress to pass a new budget next month have an impact on the equities market? If so, what's the likely impact?
Great question. And it will impact it to, I'm going to be very vague if you'll allow, to some degree. So politics will always cause short-term headlines, which drive short-term market maneuvers. And by short-term, I mean day-to-day, week-to-week. So again, that long-term look at buying high-quality investments, we look much more at fiscal policy and federal policy over the long term versus the short-term politics. So the real effect on the markets long term has to do much more with what policies are implemented and the effect that they have on the economy. But absolutely, the federal deficit, the inability of the government to pass a budget and a spending bill. I came across this recently. I forget the source. I apologize, but the Congress has to pass spending bills every year to fund the government, and I don't think they've done it on time since, I believe, 2001. Don't quote me on that date, but it was a long time ago when they actually did their job and had it done on time. So I'm currently negotiating with my bosses if I can get 20 years to get my job done on time and keep my job. So you can tell how I feel about that process. But yeah, short term, the markets will move day to day. If you zoom out, take that 30,000-foot view, the policy is what's actually going to affect the economy long term. So we try to stay ahead of that and understand what areas of the economy are still going to be there and going to prosper through different policy schemes. And we know that those change on a much slower basis than your daily news cycle.
Awesome, Pat. No easy answers, and between the election year and everything else going on, this is going to be very interesting. Next question. Why should we stay invested for the long term? Well, I hope reflecting on the last 50 years has helped answer that question. But history shows us that if you stay in a well-diversified portfolio with quality companies, and you can suffer through those 2-year to 3-year negative periods that we have historically had, you are handsomely rewarded on the other side of everything. So important stuff to think about. The last question that was sent in early today was crypto or real estate. That was the total that was typed in. So I'll reflect on crypto and real estate. With crypto, you don't have any type of a proven track record or history. I can go back to strong companies and show you what they've done the last 20, 30, 40, 50 years. Crypto, it's really a case of what someone thinks it's worth. It isn't that there's an earnings on it. There's no dividend. It's just simply a case of investing in something that you hope will rise in value. With real estate, depends on whether it's income producing real estate, personal real estate. From a financial planning standpoint, my number one financial item in a financial plan is your personal residence. There's nothing that you get greater enjoyment out of than having a wonderful, safe home for your family and for yourself. If it's rental real estate, it's the quality of the market, location, and looking at what is the marketability of this particular real estate in good economies and bad economies. If it's commercial, well, who's your tenant and what's the nature of their business for the long haul? I don't see any final questions, so our next scheduled event will be our annual economic update on Thursday, January 26, 2024 at 10 a.m. I'm sure it will be interesting. So thank you for joining us. We look forward to meeting with you soon. Have a wonderful day and a wonderful quarter. See you next year.